Hello everyone, welcome to our Egyptian Online Seminar Code. First, taking with us any questions you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Vishal Baloria. Vishal Baloria is an associate professor of accounting at the University of Connecticut. His research investigates how economic, legal, and political institutions may predictably shape firm behavior. His research has been published in top ranking journals, including Contemporary Accounting Research, Harvard Business Review, Journal of Financial Economics, Management Science, as well as the Accounting Review. Vishal serves on the editorial board of Contemporary Accounting Research. He received a PhD from the University of Waterloo and MBA from McMaster University and a bachelor degree from the University of Toronto. And he is a CBA. Now we will start our seminar with dear Professor Vishal Baloria.
Thank you, Mohammed, and thank you to all of you. I'm very much looking forward to this presentation. I always enjoy global platforms such as this, and so it's incredible what Mohammed has created here with these online seminars. I've participated and watched quite a few, and so it's an honor and a privilege to be able to present here. As Mohammed said, feel free to interrupt me at any point during the presentation with questions or comments or suggestions. This is a paper in need of feedback, and so I'll spend some time kind of highlighting the research paper, but this broader kind of literature I've been working on for quite a few years, and I'll try to share some insights just more generally on kind of the role of the media in financial markets. So this paper is co-authored with Ji-Hye Lim, who's an accounting information systems faculty member at the University of Hawaii at Manoa. So Ji-Hye and I overlapped more than a decade ago in Canada at the University of Waterloo. Um, and so she's been very helpful and useful, and I've learned a lot in kind of this data breach kind of context that we're looking at. And my other co-author on this paper is Satish Sahu, who's at the City University of Hong Kong. And Satish, equally useful and helpful co-author. He's the one that's introduced us all to the sentiment analysis, and it's very high frequency data, and he's kind of an expert in that. So it's been a combination of all three of us in terms of trying to work on this paper and improve the paper and hopefully have something to say. So as the title kind of sheds light on, the research question is, can media sentiment affect real actions? And the specific setting we look at is data breaches. And so, as I alluded to, there's long-standing literature in many areas, accounting, finance, management, and others, on the role of the media because they're such an important stakeholder in financial markets. There's been quite a bit of research done in this area, and so I think most of us might be more familiar with the sort of positive side of the media, and so what this literature suggests is that um, the media can act as an information intermediary, and so in the same way that a sell side equity analyst helps with price formation. The media can also play that role. And the media can also monitor or discipline. So in the same way that we expect external board of directors to discipline managerial behavior related to insider trading or securities violations, there's this rich literature in accounting and finance, and I've just listed a few here that kind of speaks to this positive side of the media, that it sheds light, it provides coverage, it promotes transparency through reputational incentives, and ultimately leads to better decision making at the firm level. And then there's kind of a related literature that kind of takes a more critical perspective on the media. And some of the early work in this area was Michael Jensen's work, right? The late great Michael Jensen and the theory of the press. And him and others kind of had this view that the media can sensationalize, right? That they're not always interested in providing information and or monitoring, that they themselves are economic actors, right? Media organizations are businesses. They ultimately have to generate revenue. And this sort of darker side of the media view kind of takes the position that managers managers and investors and other parties are going to make irrational decisions because of media sensationalism. And this literature is considerably less well developed than the positive side of the media. And so one can interpret that in many different ways. One perspective would be that on average, the media plays a positive role. Another kind of perspective on that is just that we don't have that same depth of research in accounting, finance, management, other areas that has shown that as rigorously. And so we with this particular paper, we sort of go towards the darker side of the media, although ex ante, the positive side of the media is possible as well. And the specific setting that we're going to look at is kind of this non-financial setting, right? We're going to look at data breaches that many of us as consumers might be aware of. I was in the context of we've been working on this paper for maybe 11 months now, and in those 11 months, I've received notification that I've been a victim of data breaches twice, right? Once from an airline and one from a consumer goods company. And so data breaches are everywhere, right? I mean, they're especially in the consumer context. And so we think of it as a very nice setting, both because it's contemporary, because it draws public scrutiny. And then the what I'll highlight is that there's things about this data breach setting that to me, to us, are highly fascinating from kind of a researcher's perspective. And so if we take kind of a step back and we think about this sensationalism role of the media, um, that Michael Jensen and others have kind of argued that the media can sensationalize. Um, that actually has its roots in crime reporting, right? And so criminal crime, right? So criminal coverage of crime in the community. It's inherently dramatic. It's attention grabbing, and so therefore it's something that all of us kind of want to know about. And so consumers are interested in crime. And so the media economics literature would suggest that it's the kind of setting in which you might expect sensationalism. And so we think of the data breach setting as kind of the corporate, the firm equivalent of crime coverage, right? Because ultimately, what is a data breach? Some hackers, penetrated an organization's internal systems and stole data, right? And so it ultimately is a cyber crime. And so we think this might be a particularly powerful setting to examine kind of the darker side of the media, because A, you have the criminal kind of component to it, which is newsworthy. And B, it involves consumers, right? And so anytime consumers are involved, there's a lot of public scrutiny over firms and the kinds of decisions that managers make. And so we think those features make it a very interesting setting. Then the cybersecurity setting itself is also highly interesting to me and to us, in part because the investment benchmark is not clear. And so, in some sense, cybercrime is difficult to prevent. And firms have economic incentives to actually underinvest in cybersecurity because they don't bear all of the costs, right? And so they bear all of the investment costs, but conditional on a cyber attack happening, the victims are usually third parties or consumers. And so it's a setting in which firms actually have incentives to underinvest, right? And this is not, a novel insight. The cyber economics literature has kind of, argued this for quite some time. And so we kind of, examine what happens when a shock happens, the shock being a data breach, and how do investment levels change, right? And from an identification or from a research design perspective, the assumption that we make that comes out of the information systems literature is that any firm is susceptible to a data breach. It's just a matter of timing, and because timing is ex ante unpredictable, that allows for kind of a generalized difference in different research design. And so all three of those features, the fact that we're talking ultimately about crime, the fact that ex-ante managers might have incentives to underinvest, and the fact that we can sort of try to get around some of the endogeneity concerns through the timing feature of these data breaches make it a highly interesting setting, at least to us, to examine. Okay. And so we ask, it's a very simple paper. We really have three core questions. Like with anything, simple questions make for complicated research designs and complicated papers. But at a very high level, the questions are fairly simple. And so when data breaches happen, does media sentiment of the firm shift negative? So that's our first question. Our second question is, how do firms respond? How do managers respond? So when we observe more negative media sentiment, does that induce IT overinvestment? So do managers overinvest in IT resources to try to calm the media down and calm stakeholders down? And then finally, we look at the valuation consequences, right? If something is truly an underinvestment or an overinvestment, then relative to fundamentals, then it should destroy value in the long run, right? And so we kind of look at the valuation consequences. So in simple terms, how does the media respond to a data breach? How do managers respond to a data breach and negative media sentiment? And then ultimately, how do investors react, right? Through valuation. And so, like I mentioned, ex ante, it's not clear. There's a large literature that would argue that the media takes a monitoring role, that the media might help enhance the efficiency of IT investment and therefore create value. And then the view that we're going to kind of emphasize a bit more is kind of the sensationalism view that managers are facing reputational pressure to buy peace, if you will. They increase IT spending to quell the pressure, but they increase it beyond kind of what economic fundamentals would suggest is reasonable, and that ultimately destroys firm value. That's kind of where our findings take us. So post-breach media sentiment becomes more negative. Firms with larger sentiment declines, so firms for which the media responds the most negatively, they're the ones that tend to overinvest. And if we look at measures such as Tobin skew, that in the long run, that ultimately destroys firm value. Okay, that is sort of just a preview of basically the core research findings that we have. I'll pause for a second just in case anybody has any questions, and if not, I'll continue. So Mohammed is asking,
Yeah.
can you clarify why the data breach can be treated as a quasi-random shock? Yeah, that's a great question. And so that's not the first time we've received that question. Um, so the idea in the information systems literature um, is that it's impossible to 100% ensure or protect against a data breach. And so it's not the occurrence of it. So everyone, any firm can and will be breached. So the random component comes to the timing element of it. When. So we use almost a 20-year sample period. And so at what point in time will a certain firm be breached is as if random. So that's kind of the assumption that we have. We try wherever we can. I'll get to our research design in a second. We try wherever we can to look at everything within a firm to kind of get around this idea of firms that are breached being different than firms that are not breached. So we try to condition our sample on breach samples and then exploit variation within that, in part because of that comment, right? The first version of this paper, we had a matched control sample and we had non-breach firms, and that was challenging for us to get around. And so everything we do here is going to be within breached firms. Every firm in our sample has been breached. Thank you, Mohammed. Great question. So like I mentioned, our first finding is that there's a sharp decline in media sentiment around these data breaches. That ultimately leads to overinvestment. And then that overinvestment behavior in the long run destroys shareholder value. Two things kind of methodologically that I'll get to that I think we're certainly all very proud of, and I'd like to highlight. First, somewhat surprising to someone like myself, who doesn't work in the accounting information systems literature, not as surprising to Jihei, who works in this area. It's actually relatively rare to have real investment data. So thankfully, Jihei had, so meaning dollars, actual investment in IT resources. That's not common in these kinds of papers. Often papers use disclosure-based proxies of investment. And so if I mention in my 10K capital investment and IT within the same sentence, and so we also look at those measures, but we do think a nice feature of our paper is that we have real investment dollars. And then more generally, this investment efficiency literature, it doesn't always kind of complete the loop, if you will, right? We essentially take it as given that investment, overinvestment is value destructive, or underinvestment is value destructive. And so our third hypothesis actually tries to kind of validate that in what we think is kind of somewhat sensible, and we'd love to hear your thoughts on how we can improve it. And so both of those features from a research design perspective, we sort of like. So I alluded to this earlier, are designed because we're looking at three simple research questions, but the timing is very complicated. So I alluded to this. This is kind of where the complexities with our research design come in. So let me kind of try to walk you through as clearly as I can the timing, certainly in working on this paper. That's helped me just kind of understand exactly what we're doing and how we're measuring things. So our first hypothesis is an event study. And so we have data, daily data on media sentiment. And so what we do, like others do in kind of a traditional event study looking at equity market reactions, is we look at a very narrow window. So when the data breach happens, we look essentially within 6 days of that breach event, and that's our event window. And then as a benchmark, we look essentially a month prior. So what was the media sentiment of this firm in the 30 days prior? So that's kind of our benchmark window. And so everything here is within firm, right? We're essentially using daily data at the firm level, and we're comparing a firm 6 days after a data breach to 30 days prior to a data breach, right? And so this is probably our best identified test in the sense that everything is within the firm. It's just a matter of sort of timing. And then for our second hypothesis, our argument is that negative media sentiment is going to induce managers to respond. And so what we do is 2 years after the data breach event, we look at the IT investment levels, essentially, relative again to the prior period. In here, we also condition on the media sentiment. So essentially, our treatment firms become firms that had larger declines, above median declines in media sentiment, and our control firms are essentially firms that were breached but had smaller declines in media sentiment. And then, and so the data breach happens in time t. We observe investment in time t plus 1, t plus 2. And so then for our evaluation consequences, we look at years 3 and 4, right? So it's kind of long-term, long window evaluation. So if I'm a manager, I'm reacting to negative media sentiment, I'm over-investing in information technology, then ultimately in the longer run, that should be correlated with value destruction. And so that's why for our third hypothesis, the value destruction hypothesis, we look over years 3 and 4. And so, like I mentioned, this is our first hypothesis. Very simple, kind of we're looking at daily media sentiment data from, I should acknowledge, thank you to the London Stock Exchange market psych indices for providing us with the data. That was a process, and so thank you to them for providing us with the data. For the breach, to identify breaches, we're using what is a standard database in this literature, the Private Rights Clearinghouse. And like I mentioned earlier, everything is within firm here, and so the event window is essentially day -1 to t plus 5 in number of days, and the benchmark window is 30 days prior. In terms of the sentiment data itself, essentially, it's for those of you that might be familiar with Ravenpack, it's similar in some sense in that it's a proprietary algorithm and it's kind of a tonal measure. And so what they do is essentially they create these daily indices from that range from -1 to 1 that capture the balance of negative versus positive tone. And the nice thing about this relative to Ravenpack is they also weight things based on buzz, meaning how much coverage is a certain article getting, and so an article that's getting more coverage will factor in more to this daily media sentiment. And so the idea is that it also captures the volume of firm mentions. And then we kind of look at two proxies. One is a general media sentiment measure. And then, as I'll explain, we also look at a media sentiment measure related specifically to cybersecurity, meaning the articles relate only to cybercrime related things, which is probably more powerful in our context, given that we're looking at data breaches. Do I see another? So Mohammed's got another question. Have you tested alternative windows, -3 to +3, to examine the sensitivity of media sentiment effects? Yeah, thank you, Mohammed, for that question. We have. The results are fairly robust. I think I'll get to this in a second. We find the strongest effects within the first week after the data breach. One of the things that the three of us talked about was that we're ultimately looking at annual investment decisions. And so we might want to think about looking at longer window sentiment measures as well. And so we have looked at, I think, up to 3 months, and the results persist, but they get weaker. And so the strongest effects we find are the ones that are the closest to the data breach event. We went with +5 only for just to capture a week, essentially. But the results are even stronger if we just center it around 2 days or 3 days. The closer it is to the data breach, the stronger the magnitudes that we observe. And so ultimately, we look at kind of this large sample. It whittles down to essentially 621 data breach events. And because we have both a treatment window and we have a benchmark window, we essentially have 1,242 observations. And so what we observe is for the general media sentiment, it declines, right? Predictably, that's what you might expect. I think the H1 is not a question, at least to us, that has a lot of tension. I don't think, right? You would expect general media sentiment to decline, and we document fairly robust kind of evidence of that. So, like I mentioned in response to Mohammed, if we look within 5 days, the results are there. They get weaker, but are still there within 30 days. And then a nice feature of this data that we're using is that we can actually do like topic analysis, right? So panel A here includes all sorts of media articles on anything related to the firm. And then what we can do is we can narrow down cyber, what they call cyber sentiment. So it's the underlying article um, is talking about something related to cybercrime. And so given our setting, it's a bit more powerful, right? And we do actually observe stronger effects in terms of magnitudes, both again in the 5 days and 30 days. I should have mentioned this market psych indices database. It covers a global set of media outlets, and so when Target, for example, had its data breach, it would include the Wall Street Journal and the New York Times, but it would also include, the Financial Times in the UK, and it would also include local media. So it's fairly comprehensive in its coverage. And so, what we conclude is that for H1 is that data breaches lead to a significant and immediate decline in media sentiment, both generally. If we look at this media sentiment 5-day proxy, we observe a 56% reduction in media sentiment. So sentiment becomes very negative about the firm. And when we look at the more cybercrime specific sentiment score, we observe even larger magnitudes, approximately 126% reduction in cyber specific media sentiment after a data breach event. And as I mentioned to Mohammed, the effect persists for up to 30 days, but it's the largest in the first week. And so we think that's a nice feature for our setting in the sense that it really is just an event study, right? In the same way that folks look at equity market reaction, right, to adverse events like restatements and AERs and various other kind of negative events. We can essentially do the same here, but we're not immediately interested, at least in investors or capital markets. We're kind of interested more in the stakeholder kind of impact, right? And so the media responds dramatically and negatively once data breaches happen. And so the next question is, okay, well, the data breaches happen. The media has responded negatively. What do managers do, right? Because these magnitudes are striking, very large reductions in media sentiment, 56% in average and 126%. So you can imagine that there's a lot of pressure on managers around these data breach events. And so what we do, I alluded to this earlier, our second hypothesis kind of tries to examine in a generalized difference in difference framework whether firms increase their investment and whether that's overinvestment. So again, a couple of innovations here that I kind of want to point to. One is there is literature that others have contributed to. So the paper that comes to mind is Reputation Repair After Accounting Restatements by Shiva Rajgopal and Ed Dahan and Jivas Chakravarti. And there are papers like that, even in this space. But where those papers kind of that line of literature where that stops is it looks at the level of investment. It doesn't really make any claims about whether that investment is efficient or inefficient or overinvestment or underinvestment. It's kind of more for reputation repair with this idea that any level of investment, I mean, those papers don't say it in I think exactly in the way I'm saying it, but at least my reading of it suggests that any level of investment would be good. It's not clear that that's necessarily the case, and so we explicitly test whether it in fact is overinvestment, and which we think is related to but distinct from other studies that have kind of looked at the investment response, right? Because we have this notion of efficiency, overinvestment, underinvestment, kind of underlying both our theoretical framework, but more importantly, our research design. So like I alluded to, somewhat surprisingly, or well, maybe not if you know the data well, it's extremely difficult to get IT spending data. It's not something that's publicly disclosed in financial statements or 10Ks. And so studies like ours often need to rely on third-party vendors. So in our case, we're looking at this computer intelligence database that covers 500,000 North American firms and establishments, I think, establishments. And it sort of captures a host of things, but dollar expenditures on IT hardware, IT software, networking infrastructure, storage infrastructure, and telecom investments. And so from this kind of vast database that we have for most of our sample period, we kind of look at two proxies for IT spending. One is the annual expenditures on new IT assets. That's kind of a flow measure, if you will. It captures the annual change in expenditures. And then we also use a stock-based measure, which is the installed base of IT capital. And then, of course, we scale everything by logged assets. And so, like with anything, one of the choices we have to make is, how do we define IT investment efficiency, right? Which is kind of a literature that's much broader than IT, right? There's a huge capital investment efficiency literature. And so one of the things that I always enjoy about working on papers is you learn about different literatures, and different literatures have different traditions. And so in the accounting literature, I think it's quite common to use something like the Biddle-Hillary-Verde kind of residual framework to capture over and under investment, right? Where you take the top quartile or the bottom quartile. We do look at that as well in the back end of the paper, and I'll show you that, and our results are robust. But this accounting information systems literature, and actually the information systems literature, not the accounting information systems literature, the IS literature, often uses the industry as kind of a benchmark. That's much more common in that literature. And so as our first pass, or as our main proxy, we also follow that tradition. So IT spend is relative to the industry year mean, and similar for IT stock. There's some research in accounting where people use industry benchmarks as well, but that tends not to be as common. And so because we're looking at kind of an IS setting, we follow the tradition in the IS literature, and overinvestment is investment simply that's higher than the industry year mean. And so, like with anything, that has some assumptions baked in, and so we try some other models, and the results are fairly robust. And then here's kind of a critical component. Our left-hand side variable is this overinvestment variable. So the firm's spending relative to industry peer spending. And then what we're going to do is our treatment variable is really this high decline post, right? So a second ago, I just showed you that media sentiment declines very rapidly after these data breach events. What we're going to do is we're going to cut on that. We're going to cut on how severe was the media decline. And so we're just going to essentially take within our set of breach firms that had the above median media sentiment decline, and we're going to consider those are treated firms. And then we're going to look at firms that had below median decline in media sentiment as our control firms. And the idea is that if media sentiment is what's causing this overinvestment, then you should observe it when the media sentiment is more negative, right? And so slightly different sample here, in part because of the IT spending data is not always available for the first 5 or 6 years of our sample period. So slightly different sample. Even in the univariate, we observe kind of results consistent with our hypothesis, which is the treatment group has higher levels of IT overinvestment in the pulse period. And then we essentially verify that in kind of a multivariate context. What we observe is that IT spending surges dramatically, conditional on 2 things. One, a data breach, because like I mentioned, every firm in our sample has been breached, and then above median negative media sentiment. So when managers are facing the pressure because they're getting killed in the media, what they do is within the next 2 years, time 0, time 1, time 2, they increase their IT spending levels by 122%. So, in terms of magnitudes, we're talking about fairly dramatic increases. And so for $1 billion firm, that would equate to about $11 million in incremental IT spending. And for the median sample in our firm, that equates to about $72 million per year of increased spending, some subset of which we'd characterize as an overinvestment. And then we observe similar results with our stock measure, about very similar magnitudes, about 124% increase in IT capital stock. So let's see. How do you address the possibility that firms with more severe breaches naturally invest more in IT independent of media pressure? Yeah, that's a challenge. That's a great question, Mohammed. So that's a challenge in our context because there's several forms of endogeneity bias, right? The first one is that we talked about earlier was what determines whether a firm is breached or not. So we kind of sidestep that issue by only looking at breached firms, right? Now, the second issue is the one you're pointing out. The breached firms with more negative media sentiment might be different than the breach firms with less media sentiment, right? And that may be driving our behavior. So one of the nice things about doing a presentation, and I've mentioned this to Satish, presented this last week or the week before, and then I'm presenting it here. One of the things that comes out of that process is the paper gets better even before you present it because these kinds of considerations come to mind. And so I don't have the tables, but one of the things that Satish realized when he presented, before he presented 2 weeks ago, is exactly that point. And so what we've done is we've essentially run this regression where we call them falsification tests, where we replace the media sentiment decline with other proxies for breach severity, such as the investor reaction, for example, such as in this database, you actually have proxies for breach severity, which captures the number of records lost. We look at, so those are 2 things that come to mind. Investor reactions, breach severity, and we find no effects. So those are kind of placebo effects. So there's something unique about the media, when we condition on above media decline that's driving this. We don't observe things. We don't observe that more severe data breaches cause the same IT overinvestment. So I mean, that partially addresses your concern. We're thinking of other ways to kind of address that concern. It's a challenge. So if any of you have thoughts on that, that would be great. But that's all I can offer right now. That if we condition essentially on non-media stuff, we don't observe similar findings. So thank you. Great question. Um, no. So did we conduct an experimental study? Thank you, Nadia, for the question. No, uh, I mean, we have a quasi-natural experiment in the sense that we're using observational data, and we claim that the timing of it is uh, um, random, and so therefore that allows for causality. I'm not, none of us are experimentalists, and so while I agree with you that that might allow for, uh, the nice thing about experiments is that the causal inference is much stronger than in the lab, than because you can manipulate and control things. Than kind of using observational data. The trade-off, of course, is we're looking at real firms, real IT expenditure data, um, greater external validity perhaps in observational studies, and greater internal validity in experimental settings. I mean, that's as much as I understand experiments, so I don't want to go any further than that. So there's trade-offs with each method. So thank you for that. We hadn't even thought about it. But yeah, perhaps that might help. And so with our second hypothesis, essentially what we're finding is evidence consistent with negative media sentiment declines inducing IT overinvestment, right? Again, in the magnitudes here are striking. But to us, they make a lot of sense in combination, right? Earlier, I showed you very dramatic declines in media sentiment, right? I mean, a 56% reduction in media sentiment is huge. That essentially means that you're getting a lot of negative coverage, and it's very intense. And when we zero in on cybercrime, that becomes even stronger. And so, in that light, you can imagine a manager is facing quite a bit of pressure from the media, right? Because they're getting killed in the media. Lots of negative articles about their firm, um, and this I think will go back to Michael Jensen's work in this area. The media prefers simple narratives, right? Right. I mean, so if you read these articles, and we have, often, like when Target was breached, it's why did the firm not invest more? As you know, which implies that if Target had invested more, that it would be able to perfectly insure against a data breach. That, of course, is not true, right? You could invest billions of dollars and still be subject to data breaches. And so the media kind of narrative around some of this can be simplistic in nature, right? I guess is a better word. And so if a manager is getting criticized for not investing enough, a natural reaction might be then to increase IT spending, right? To quell that pressure, so that you can prove, hey, look, I did increase my spending, right? We are taking this threat seriously. That's kind of the underlying kind of sort of background story, at least that I have in my mind, in terms of what's going on here. And so now the question is, okay, well, of course, like anything, our overinvestment proxy is imperfect, right? We're just taking an above median industry proxy. Do I see another question in the chat? Could the IT overinvestment measure be refined, benchmarking at the two-digit estimate mask heterogeneity within industries? That's a great point, Mohammed. We hadn't actually we've looked at different models for trying to predict uh, IT overinvestment or underinvestment, but I don't think we spent that much time within looking at NAICS codes or using three-digit SIC or four-digit SICs. So we can, as far as I know, I don't think we've done that much robustness on that, but we probably should. I agree with you that two-digit might be coarse. So thank you for that suggestion. And Mohammed's point brings up kind of a related issue in this investment efficiency literature more broadly. That we can label things as overinvestment or underinvestment, but can we substantiate that through some sort of decline in operating performance or valuation? As far as I know, that's actually somewhat surprisingly not done very commonly in this literature. So we do think it's complicated. It's taken me about 10 months to understand our research design for H3. Most of Satish is great. He's kind of the leader in pushing this forward, and a lot of our conversations is just me trying to understand exactly what we did for H3, because I think it's a really important and useful test. But predictably, it's very hard to get right. And so we're trying, and any feedback you have on that would be helpful. So at a very high level, I'll go back to the timeline that we had, because I think that, to me, anytime I get confused, it helps me understand it. So what I've just shown you with H2 is that in years, T0, when the breach happens, year 1 and year 2 after the data breach, what we're observing is an overinvestment, right? IT spending increasing dramatically. And so I think from a valuation perspective, you don't want to measure the valuation response contemporaneously. Rajiv Banker has some work in management science and kind of this area around the Y2K kind of shock, like 25 years ago, where he does kind of some valuation tests. Those are kind of more value relevance kind of tests, but we sort of were inspired a little bit by that type of thinking. In our context, we think it makes more sense to look at the valuation after the investment period is over, right? And so the question is, how long are managers going to how long is their investment response going to last? We think it's going to be longer than just year T. We think it's going to be in the short to medium run. So what we're observing is the overinvestment behavior persists up to 2 years, which we think is reasonable, given that ultimately what we're talking about often is real investment data here. So we're talking about capital expenditures, right? Like in hardware and software, like physical capital. That's kind of what we're talking about here. And so those kinds of decisions are not just made for 1 year, right? They're often made in kind of a multi-year kind of framework. And so for that reason, we favor kind of a 2-year kind of investment response window. And then we want to look at valuation immediately after that, so years 3 and 4. And so that is kind of what we try to do. So we look at Tobin's Q, different variants of Tobin's Q, right? But at a very simple level, it's defined as the ratio of market value of equity plus liabilities to total assets. So the basic idea is how does the market value the firm's overall kind of structure. And so that's our dependent variable, right? No innovation there, right? We're just borrowing from kind of the long literature in accounting and finance on capturing Tobin's Q. The independent variable is kind of where things get interesting for us and confusing for me. So what we do is, again, we're conditioning everything on that media sentiment decline, right? Because our story is really that the media is kind of a key player in driving the investment response by managers and then the valuation response by investors. An indicator for firms with above median sentiment decline post-breach. So that's the same as it was in H2. And then here, the only difference is that the timing. We're going to measure this in years 3 and 4. And we're going to use year 0 as kind of the benchmark here, with the idea that we kind of remove years 1 and 2, which is kind of the managerial investment response, right? And I think, the reason this test is important for us, and, again, we're actively working and trying to kind of improve it and make it more credible, is there's nothing in the paper until now. There's no table I've shown you uh, that can allow us to clearly say that the media is not monitoring, right? Because here with H2, it's entirely plausible that firms were underinvesting previously, and that the only reason we're observing overinvestment is because the media is correcting that off equilibrium response, right? So this result, in theory, could be consistent with the monitoring story. But if it was truly a monitoring story, then what we should observe is increases, right? In firm value, if the media comes in, helps take firms away from this underinvestment equilibrium, right sizes their investment levels, then what we should observe in the long run is firm value increases. But we actually find the opposite of that. We find declines in Tobin's Q in sort of the order of magnitude of around 10%, which for our sample firms kind of equates to around $3 million. And so this is not at all consistent with a monitoring story. It's more consistent with this the darker side of the media, a managerial overreaction. In other words, it's more consistent with a managerial overreaction to the media as opposed to a managerial appropriate reaction to the media, right? Because if it was an appropriate reaction, if the media is coming in and resolving some agency issues that existed at the firm, then we should observe that in higher valuation, but we don't. We observe the opposite. And so we think this is kind of a close the loop type paper or test, I mean, in the sense that it helps us differentiate between the monitoring and the sensationalism, positive role of the media in this context, or the darker side of the media, negative side of the media, right? This is kind of the core test that we have in the paper that allows us to say, well, at least in this context, it's not monitoring, right? And so we think for that reason, it's kind of a very important test, both for our paper, but just more generally, I think as well, right? I mean, I think I've been pushed in other papers myself, and so I think we're all guilty of this, right? I've been pushed myself that why are you just assuming that these investment efficiency um, uh, measures are value destructive? Like, why don't you show me that? I have other papers where I've been criticized for that, which I think is a valid criticism. And so here with this particular paper, we are trying to kind of go down that path. But of course, that's easier said than done, right? There's a reason why others have been reluctant to do it, because the research design becomes very complicated. And to kind of make inferences about three different actors, we essentially have three different actors in this context. We have the media, that's our H1. We have the managers in H2, right? The investment response. And then we have investors here. So, I mean, all of that's quite challenging to do well in one paper, right? And so, that's why this paper is a work in progress. The comments thus far have been very helpful in trying to push us to think a little bit more deeper about all of this. So if you have any comments on the remaining tests, feel free to chime in, please. And so, like I mentioned earlier, one of the real challenges for me, because prior to this, I'd never worked on a paper on what I'll call the information systems kind of literature, right? Because this paper is some combination of accounting, because in accounting, we care about investment, we care about valuation, and we care about the media because the media is an information intermediary. Finance, because finance folks tend to care about all three of those things as well, and they're particularly these days concerned about cyber risk. And information systems, of course, right? I mean, we're ultimately looking at cybersecurity and data breaches. So like I mentioned earlier, unlike in accounting, where the Biddle, Hillary, Verdi kind of residual using sales growth as a proxy for investment opportunities is common. In the IS literature, it's not. Even in the finance literature, it's not as common. And so that's why we wanted to go with the tradition in the information systems literature, and we use that industry benchmark. This is just meant to, show the accountants in the room that we find similar results when we use a bit of Hilary-Verdi residual based kind of proxy. We again observe overinvestment, and then here's kind of where I think we have some really interesting kind of results. I alluded to this earlier, right? So Ashraf and Sundar, I think that's an accounting review paper, and then a KAL, that's a review of finance paper, I believe. I alluded to this. One of the revelations to me, not so much to Jihei, but to me and Satish, was the fact that a lot of what's called IT investment is often a disclosure-based proxy. So we have these disclosure-based proxies for investment. And that's just a data availability issue, right? I mean, 10Ks are available to us as researchers, whereas IT spending data is not typically. In the information systems literature, the data that we're using is actually much more commonly used, and so thankfully we have Jihei on the paper, and she was very helpful in making us aware of this data and sourcing that data for us and helping us understand that data. But one of the things we do want to do is we did want to kind of reconcile back to kind of the state of the art in the accounting and finance literature in this. And so what the Ashraf and Sundar do is they quantify the mention of cybersecurity software packages appearing within 10 words of capital expenditure terms in the MD&A section. So we do the same. And then a KAL do something similar, but their sort of dictionary is slightly different. They use IT security terms, and they look at within 100 characters as opposed to 10 words. But the same basic idea, right? We're going to look at 10Ks. We're going to parse out certain sections of the 10K, like the MD&A, and then we're going to look for kind of some combination of IT and capital expenditures. And from that, we're going to infer if they're talking more about investing, then they must be investing, right? That's kind of the assumption, I think, in that literature. So somewhat interestingly, we actually do not find any effects using either of their measures. And so we've thought, so these disclosure-based investment proxies, we don't find the same overinvestment, if you will. And so we've thought about kind of trying to understand that in the context of our paper, and then also to kind of reconcile back to, these are both nice papers. We've learned a lot from reading these papers. Some subset of the authors have given us feedback on our paper, and so we've tried to reconcile back, and I go back to, in my mind, I go back to these magnitudes that we're documenting. 56% reduction in media sentiment, 126% reduction in cyber-specific sentiment. Something in a 10K is not going to be enough to quell that pressure, right? Like just words in a 10K, right? These disclosure-based proxies, making symbolic changes, management making symbolic changes is not going to be enough, I think, to quell that pressure. We argue in the paper, and admittedly, this was an ex post kind of explanation, is that you need real changes. You need real dollars to be spent to quell that media pressure, right? Because what the manager is trying to do is they're trying to reduce the media pressure on themselves and on their firms. And so we argued that you're going to need real expenditures, real money, dollars being spent on IT spending that you can validate, as opposed to something in the 10K that's words-based, right? And so we argue that in our context, at least, when you observe such severe declines in media sentiment, words in a 10K are not going to be enough is kind of how we're interpreting the result, but we're open to that, of course, is exposed. So there may be other plausible alternatives for interpreting that result. So we're kind of more than open to any thoughts and suggestions you have. And then, we do kind of some heterogeneous effects or cross-sectional tests. And so we argue, okay, well, clearly we're observing some evidence of overinvestment behavior on the part of managers here. And so then we look to the literature and we look at kind of the characteristics of firms that might be more prone to this kind of overinvestment behavior, right? And that's kind of where Michael Jensen's more traditional work that I think all of us are a bit more familiar with in the 1980s, not so much his work in the press that has sort of been well, for him, been underappreciated, right? Everything is relative. It's Michael Jensen, but I think many people think of Michael Jensen for empire building and agency cost of free cash flow, and so we went to that literature and we said, well, what kinds of firms are typically much more prone to overinvest? It's typically firms that have limited growth opportunities, right? Firms with lower operating performance and firms with lots of excess cash or internal sources of liquidity. And that is actually where we observe much stronger effects, right? So we find that firms that might be more prone, that might have the characteristics of firms that look like they may overinvest. We argue that the media nudges them in kind of that direction. And so firms with limited growth opportunities, lower operating performance, higher internal liquidity, they're the ones that are characterizing our investment response, which makes complete sense, right? Because to us, at least, in the sense that agency cost of free cash flow hypothesis, ultimately it argues that that's value destructive, and that's what we find, right? That these are value destructive investment responses, and so that's essentially kind of what we find. Here are some nice graphs that Satish prepared to convince you that we have parallel trends. We do. So I do want to spend a few minutes kind of just talking more generally, Mohammed, if we have time, and I see you have a question as well. Do governance characteristics, board cybersecurity expertise, CEO tenure, institutional ownership moderate the effect of media sentiment? Yeah, that's a great question. We hadn't thought about it from that perspective. So going back here, you're essentially saying, Mohammed, that, correct me if I'm wrong, that there's governance mechanisms that can prevent all of this, right? Like external board of directors, if they're independent, or audit committees, so on and so forth. We haven't actually gone down that path as far as I know. We should, because there likely are factors that could weaken. Even if managers want to overinvest or are pressured to, there might be compensating mechanisms like institutional owners or board structure. We haven't. That's a great suggestion. We haven't kind of looked at that. And so, I'll kind of close. Mohammed, if it's okay, I'll take about 5 minutes to close here, and then just maybe another 5 minutes because I've been working in this media literature more generally to kind of just offer some broader thoughts beyond this paper. And so I promise I won't take more than 11 minutes of your time. With this paper, I think what we're able to kind of do is take, what I think of, or what we think of as kind of the roots of media sensationalism. It's crime reporting. That's what the media literature would tell you, right? When did the media start sensationalizing things, or for what kinds of events? And going back, centuries, the answer is that for crime events. Yet we don't really have that much or any evidence that we can find, at least. Well, no, I shouldn't say that. We don't have very much evidence in the corporate context, right? And we have cybercrime, right? We have data breaches, which are essentially corporate crime. And so the UK paper that I alluded to earlier, for example, in Review of Finance, what they do is they also look at responses by managers to data breaches, but they stop short of kind of saying whether those responses are good or bad, right? It's kind of much more levels oriented in the sense that when data breaches happen, managers invest more and do various things. They don't necessarily answer the question, is that good or bad? And so I think our H2 and our H3 kind of try to answer those questions, right? And we try to argue that or interpret the evidence as suggesting that it may be bad, that this is a context in which underinvestment is actually rational. Because of externalities, the firm doesn't bear all the costs of a data breach. All of us do, right? Consumers do, and maybe peer firms do, and maybe other stakeholders do. But the firm itself doesn't actually bear all of the costs of data breaches. So ex ante, it's not rational for them to invest in securing against that, right? Because if they invest, they bear all the costs, but only reap a partial benefit. And so we think we kind of bring those two strands of kind of literature together, kind of the media and the cybersecurity kind of literature together. So we think that's kind of our core kind of contribution, that we've identified a setting, doesn't have to be every setting, but a setting in which overinvestment is kind of to us a reasonable response to be expected, and that hopefully we can correlate with value destruction, right? And that's kind of where I'll leave off with that particular kind of conclusion for this particular paper. And then kind of my final point is just because I've spent quite a bit of time in my own work and others' work on kind of thinking about the role of the media. I do want to kind of be clear that I do think a free and independent press is an important part of kind of a healthy kind of capital markets, healthy democracy, right? And so that's certainly so my view is not that the media only does bad things. That's certainly not my view. I've got papers that document that the media plays an important monitoring role as well, and others do as well. It's about striking a balance, right? Like any actor, right? Any stakeholder, right? Can all of us as human beings, right? Can do good things and we can do bad things, right? And so the vast majority of the literature, in my view, tends to kind of emphasize the media's positive role, which is valid. There is a positive role, but I think we need more studies to kind of provide a bit more balance, right? Are there contexts like the one we study, for example, where the effect might be more positive, or it might be, less positive, or neutral, or even negative, right? Just to provide kind of a more fulsome picture of the media, and what are those kinds of events, right? When is the media more useful? When is the media less useful? Can other can other actors, whether it's social media or sell side equity analysts, help with certain types of events, whereas the media can help with other types of events? I think kind of a better mapping in that sense would kind of help move this literature forward. And so we're just trying to do our small part, right? A very small part of kind of this literature on the media to kind of move this literature forward. Even in 2025, I think it continues to be important. It's a big part of a healthy capital markets, healthy country level institutions, right? And so, with that, I'll close and thank Mohammed for organizing just this wonderful global kind of forum for all of us to meet, and for all of you for giving me feedback. So thank you, Mohammed.
Yeah, thank you very much, David, Vishal, for your contribution and your effort. It's really an excellent presentation and excellent paper. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question. Nadia? There is questions about how might the result different in countries with different media environment or strict data regulation.
Yeah, that's a great question. That's a great question. So you're 100% correct that we're looking in the US context. All of our firms, at least, are in the US. Our media proxies, our media articles can come from outside the US, but probably most of them come from within US financial markets. I'll have to check. I think there is kind of interesting work being done in that area where people are looking at like the literature, I guess I'm most familiar with in the international context is within mainland China, state-owned media or state-controlled media versus independent media and how the effects can be different. So like anything, I think governments have a role to play, I think, in promoting appropriate decisions. I think in this context, actually, for example, I might expect that government-controlled media or state-owned media might have less negative and maybe even neutral or positive effects in this particular context. Because you have to understand the economics of governments. What they do is they can understand everybody, right? Who are all the different players, right? And so I think in countries where the government has kind of a strong influence uh, on media, the results might actually be the opposite, right? We might actually observe more of a monitoring role, or certainly maybe not as severe of a negative effect. But of course, in other contexts, like in political contexts,
Mhm.
state-owned or state-controlled media can be problematic, right? For other reasons, right? And so, yeah, that would be. Uh, I would find that highly fascinating if someone did a study that kind of did this across countries, right? And that would be interesting. It's an empirical question. I can guess, but I don't know, right? So thank you for the question.
Thank you. As another question, if anyone have any questions, you can on your mic and ask your questions. Another questions here. Have you considered whether social media's sentiment, like Twitter, may extra similar or stronger pressure than traditional news outlets?
We did do we at some point we did look at doing similar tests with social media sentiment. I think what we found was with all of that's now removed from the paper just because paper, just even on the traditional media, is kind of getting out of control, and these papers get unwieldy and too long and difficult to understand. So we removed all of that. But we did find, I think, um, similar but weaker effects for social media. And so social media is kind of interesting relative to traditional media because the social media can sort of capture the wisdom of the crowd and capture much more of the consumer response, perhaps.
Mhm.
But the social media may not have the same incentives to sensationalize like the traditional media, right? Because the traditional media is trying to make money,
Mhm.
right, by getting people to pay attention to their articles. Social media, I may be a consumer, I may be a victim of data breach, and I'm just trying to vent my frustration that I got data breached, right? And so it may not be as and then managers uh, response is also going to vary. So we found similar but weaker evidence essentially in an early version of this paper for social media sentiment. But just to keep the paper more tractable, we've gotten rid of kind of that entire kind of set of tests.
Thank you. Another point, is there a variation in the effect depending on whether the media source is national, or local, or industry specific?
Yeah, that's a great question. We should look into that. I think I've asked Satish about this. One of the challenges with this database that we're using, and again, we're grateful that they were willing to share it with us, is like Ravenpack, which is commonly used in the literature. It's kind of a black box, to be honest with you. It's very difficult to get that level of detail. So what we observe, we don't construct these sentiment scores. We we only observe the aggregate sentiment scores
Mm-hmm.
that's reported for a day. And so I'm pretty sure I've asked Satish this. I don't think we can actually break it down by, let's say the New York Times or the Wall Street Journal versus the Boston Globe or something like that, national versus local media. I think if we were to try to replicate this analysis using Ravenpack, we could, right? Because in Ravenpack, you can you can filter which media sources you're using, or Factiva if we wanted to do it manually. With this specific database that we're using, as far as I know, we don't have media outlet level data. I would expect that, the broader literature to answer your question, although we can't do it, at least with the existing data we have, the broader literature would suggest that the response would be stronger for national media, right? Because more people follow the national media nationally and internationally than the local media, right? That would be the expectation. So that's a great question. Maybe we should think about, the benefit of this sentiment thing is that it's daily data and it captures not just the sentiment, but also this buzz-weighted kind of idea that the more negative it is, the more negative an article, it gets a higher weight, essentially, I think is what this buzz weighting does, which is nice. But it comes at the cost of not actually having outlet level data. So maybe we can think about trying to complement it by doing that through other data sources. Thank you.
Are there other questions? If you have questions, you can open your mic and ask your questions. Have you considered explore heterogeneity across firm size or industry, cybersecurity intensity?
Yeah, that's a great question. We have tried to kind of shy away from this industry level test because of the way we define our overinvestment, right? Like everything is kind of within these two-digit SIC. On the firm size, I'm pretty sure we have, and I think what we found is that it's larger firms that have more that behave more consistently with the way we're suggesting, that they tend to overinvest and that they tend to destroy value. So I think we've kind of pared down this table to only focus on growth opportunities, operating performance, and internal funding. But earlier version of this paper did have firm size, and it was larger firms, which is more or less consistent with kind of, I think, the agency cost of free cash flow type story, right? Large firms with declining growth opportunities are the ones that overinvest and destroy firm value. And so if that's that, we are finding it among larger firms, if my recollection is correct. Thank you for the comment.
Thank you. Last questions about the economic significance of your result. Could you more explain about?
Yeah, I mean, I think in terms of the magnitude of kind of our results, right? I would say the core result that we really have that's meaningful is this one, in the sense that everything leads to H1, and H1 is leading to H2, and H2 is ultimately trying to lead to H3. So, what we're talking about or what we're documenting is very large increases in IT investment, right? So $11 million incremental IT spending for $1 billion firm. For our median firm, it's actually 72 million because we have large firms on average. So we're talking about $72 million more IT spending in a given year. And then if we average that over our entire investment period, that's like $215 million or 508 if you look at our other proxy. And so to me, those are huge numbers. And so to me, it's not surprising that we also observe in the longer run large declines in firm value. So essentially firms, you can think of, in very simple terms, you can think of firms that listen to the media after a cybersecurity breach destroy value in the magnitude of 10%, right? I mean, that's huge. That
Mhm.
in years 4 and 5, your valuation is 10% lower in Tobin's Q. So to me, I mean, is the effect size too small is not an issue. We can quibble about whether it's too big and whether other things might be driving it. Our design is a work in progress, and but yeah, 10% to us is not small at all, right? In terms of the value destruction, especially given that these data breach events, they're fairly isolated in nature, right? I mean, meaning it's difficult to entirely protect against them, and so it's not clear that some of the blame, of course, has to go with management, right? Clearly, the managers, all of us, can always do more to prevent these kinds of events, but there's just some inherent risks that are impossible to control against, and so I think this 10% in light of kind of managers destroying value is huge. Thank you for the question.
Thank you very much, Professor Vishal, for your contribution and your effort. Thank you, everyone, joining us today, and thank you very much for taking the time to present to us today. It's been appreciated. Thank you,
Thank you, Mohammed. Thank you, everyone.
yeah. And I hope to see you soon in Egypt. You are very, very welcome.
Well, thank you. Likewise. Yeah, I hope so as well, right? I hope so as well.
Yeah.
Thank you.